I've got only one topic. It's going to be much quicker than all this, and it's the BlockFi Bitcoin Rewards credit card and why it's stupid.
Tell me, what's the cash back here, or what do you get actually?
I'll get into the whole thing. Don't you worry, dude. Unless you want to start with that topic.
Yeah, let's start with it.
All right, this is why Bitcoin cashback rewards as a premise is stupid. First of all, start with the high level and then go into this specific offer. All right, so cashback rewards on a credit card are treated by the IRS as a non-taxable rebate for your purchase. So that's a really nice little thing. So if you're getting cash back, if you're getting any rewards, points, whatever the value is, you'll notice that never makes it onto your tax return. That's because the IRS calls it a non-taxable rebate as part of your purchase. Pretty nice. The issue is if you get something, so they've now tried to get these sponsors to find a way to give people Bitcoin or the ability to buy Bitcoin as part of their rewards. And the problem with that is that if you compare it to simply getting cash back, which you can always get, and I recommend that anyone like trying to get their head around this, look at this Citi Double Cash credit card as a baseline of what you can get. You get 1% back on purchases, 1% back on payback. So functionally, 2% in cash off of everything you spend on a credit card is kind of I consider it like an index fund, like a baseline of what you can get with no annual fee. Very simple, straightforward.
By the way, it's highly rated, that card that you just mentioned, the Citi Double Cash. It's one of the best rated cards. It's
my daily driver. So that's 2% is in cash, in non-taxable cash, by the way, should be your baseline there. The issue with receiving Bitcoin is that you're getting tax-free Bitcoin as a reward instead of tax-free cash. Okay, no problem with that on the baseline. But currently, Bitcoin is not an actual functional, usable currency. You can't really sell it for anything. And it's also taxed as a capital asset. So what that means is, let's say you receive 0.001 Bitcoin or whatever you get in cash back, and you want to, instead of just stacking it, you want to sell it. When you sell it, that's the sale of a capital asset, meaning you owe capital gains on whatever that is there. And by the way, you have zero basis because in the absence of any cost basis, which you don't have cost basis because this was a non-taxable reward, you're going to pay income tax on the full amount of whatever that Bitcoin sale was. And if you do it within a year of the time when you got it, that's a short-term capital gain. So that's a terrible trade. Not to mention the credit card that just came out, the BlockFi one, pays 1.5% back in Bitcoin. So if you're comparing the Citi Double Cash at 2% to the BlockFi 1.5% in Bitcoin, you're getting a way worse tax situation and a less useful, highly variable currency investment piece. You would be way better off. You have a 33% boost in rewards if you just use your Citi Double Cash cashback to go and buy Bitcoin if you really want exposure to Bitcoin.
So what cards are examples of the Bitcoin cashback that
I think there's only one. And it's the BlockFi 1.5% Visa cashback. And I think it's brand new. It may not even be out, just a waiting list. But this has been a big announcement in the Bitcoin world. BlockFi is a huge player. People care about it. So it's a product that's being talked about and touted as if it's relevant. I think it's a poor offer.
Got it. Yeah. So essentially taxed when you sell it, the Bitcoin.
You get you get 1.5% instead of 2%. Start with that. And then you get a way worse tax situation.
Yeah. It says here, though, to earn 2% back in Bitcoin on every purchase over $50,000 of annual spend.
You can look at, there's a great blog post by my friend Adam Collins at Movement Capital. We'll link to it below, about the psychology of credit cards and how they're always winning at these games. You're so much better off paying cash, not using plastic in the cases where it's possible to do so. So that you'll just dwarf the amount in rewards that you receive by spending less psychologically if you pay with cash, which is harder post-COVID. No one's accepting cash, or many businesses aren't. It's just harder to get. Feels dirty. People aren't doing it. Whatever.
Yeah, it's very hard. Like I think, yeah, it's becoming harder and harder, especially in Latin American countries. The governments want people to use credit cards and debit cards because it's bringing the consumerism within the taxable economy, essentially. So it's not in the untaxed gray to black market.
Right. It's an onboarding mechanism. Ditto with, I think, to China too.
In Uruguay, the restaurants, for example, you get a discount on the VAT. So you don't pay VAT, a huge portion of the VAT tax if you pay with a credit card, because they've noticed that restaurants are like the biggest
tax dodgers.
Yes. My topic for today is about, the first one is more of if you're putting together your estate plan, you should be careful how you set aside the main house, your primary house, assign it to your heirs. In most cases, people will live there, they will pass away, and the house itself gets settled down to the heirs, and the heirs have to decide what to do with the house. Now, many people will say that's a harbinger for a bad outcome. Essentially, because of the optionality, because of the things that can happen to the house, there's room for fights. And if you care about anything post-mortem is to maintain the family unity, then you should actually set aside some default instructions for what to do with the house. And what many people say is that the best, especially in this market, right? The best idea is to just assign or tell the I think it's a trustee that you want the house to go on sale,
or
and
executor.
Then to have the house go on sale, and the proceeds be delivered to your beneficiaries.
Yeah, I think that's sensible. I think the alternative, so the choice to not do that, is functionally handing down a group project economic decision right after you die, right? Like, hey, everybody get together and come to a consensus. And it's someone's job to try and mediate, try and build consensus. And you can imagine, if with a little bit of empathy, that's not probably what everyone wants to spend their time doing. So there's kind of the gift of clarity if you choose hey, here's clear decisions route.
Yeah. And the other part is, if someone really has done well, if one sibling has done well and they want to keep the house, that there should be a buyout clause, right? So the sibling will have the first right of buying that house. So let's say they go to market, they find a buyer, the buyer will pay, let's say, $1 million. Then the sibling has to come up with an equivalent amount to buy at the house. And so that's a fair price. It's a market price that will be dispersed for the other siblings. So if there's, let's say, 4 siblings, then if the market price is 1 million, it'd be 250 for each one. Then if one sibling wants to buy it, then he would have to pay up 750 and give it to the other siblings.
They would have to pay $1 million to the estate. They would get 250 back. 750 would go to the others.
That's correct. That's the proper way of doing it.
Right.
Because the state owns the house now. The other topic I want to talk about is why you should not set yourself up to get a tax refund. And so what I mean by this, and it's a little bit, I like this clickbait kind of title I set up, but it's essentially make sure you're withholding correctly, not over withholding, right? Because at the end of the day, there's an opportunity cost with the capital that the government is taking out of every paycheck. And while it's great to receive a nice little refund, it wasn't really the efficient thing to do. And so I do recommend everybody at the beginning of the year to always review what they think their income is going to be this year, and then set up accordingly proper withholding. And that's something you should probably do with your tax accountant. You should just tell them, hey, I estimate this is going to be my income for the year. Can you help me draft the new, I think it's a W-4, right?
That's right.
The new W-4, and then you hand it over, if you're an employee, you hand it over to your HR department, and the HR department should adjust the payroll withholding for that.
This is a juicy one. So yes, pure efficiency wise, you should probably, if you think the expected return of your investments is always positive in any given year-long period, you should minimally withhold, but still avoid underpayment penalties. Always invest the excess cash and probably owe at tax time, but not owe penalties, right? If you're following that logic.
Yeah.
Pure efficiency.
Yeah. I mean, that's the most efficient way of doing things. And I think that there's a valid reason for that. If you're a business owner, your cost of capital is and if you're using it to expand, then, you should probably do that. Taking out a loan from the government is a better deal.
Sure. Also, you can borrow from the IRS at cheap rates every April and say, hey, I can't quite afford my payment, and get very cheap loans.
And so those are things that, I think most people will be shocked, if they don't pay their tax bill. But there's a lot of people who end up not having the cash flow in a specific year to pay the tax bill, and they enter into payment plans.
Quite a lot.
I don't know how common it is. I haven't seen statistics, but I bet you it's not, it's material probably.
Surely.
So, yeah, I mean, it feels better to be on this side where you don't owe money to the government, but
right, which gets to this, like, all right, there's this trade-off between raw efficiency, where we know that we'd rather use cheap capital to invest, keep a little bit more levered balance sheet. This is like, a private equity strategy with yourself personally, just getting the cheapest loans you can and investing all your capital. Or you can use the much more conservative take, which is withhold more aggressively, always get money back, and be able to deploy that on a slower time frame. It's kind of a frequency question, right? It's like, do you want that cash delivered to you every paycheck, whatever, 48, 50 times a year? Or do you want that cash once a year in April? There's a big question of what's better for you behaviorally, like what's going to end up in a better situation for your total economic situation. How long ago did you start your business?
Part-time 2011, and then like full-time 2018.
Okay. From 18 through 2020, what has been your personal experience with tax time? Have you generally owed, or have you generally gotten a refund on your family's?
I've always owed.
Always owed. Okay, so you've gone on the aggressive side of this. You're following the efficiency doctrine.
I'm following the very efficiency doctrine, sometimes too efficient.
Okay, got it.
It's hard. Like sometimes you find that you need to spend money that you had previously allocated for taxes, and then suddenly the last 3 months before tax time, you start having to save all the money that you make for taxes.
That was my next question, is what's the behavioral effect of that, of generally knowing that you're going to owe?
I would say more cautious on my investments. I think it truly makes me more cautious on my spending. Because I know exactly, like every month, if I make, I save 50% for taxes, right? So I know it's a little bit over what I need to, but it comes close to that number. Because you have the FICA taxes, which is 15%. And then you have income taxes and state income taxes. So if you add all of those together, 15 plus, let's say, 27 or 20, let's say 25 to be pretty close. You're at 40, and then the state, it's like 7, you get to 40, 47, right? It's a little bit more actually. I get to 50%. If I make $5,000, I have to put away 2,500. And if I don't do that, like, yeah. So then I have to go into my QuickBooks and see what was my revenue and just have to make sure that the half of that is in a tax account. I need to actually open up another broker account. People say like, oh, open up a savings account and put the money you need to to pay for taxes. I'm like, open up the broker account and just invest it instead of sitting in cash.
I follow on the efficiency doctrine, but don't you have an S corp? This is getting into deeply personal stuff.
I do have
so
an
S corp is supremely suboptimal for positive expected return investments. It's like one of the worst vehicles for owning investments in.
But the S corp doesn't pay taxes. It's just a pass through.
The S corp pays. Here's the issue: if you have highly appreciated assets inside an S corp, it's a problem because you would pay taxes either on disposition or on distribution of those assets in kind. Yeah, so it's a bad setup.
Yeah, but I wouldn't set up. I would set up on my personal. I would distribute the money.
Good. Okay.
Yeah.
All right.
At the end of the day.
And I echo your sentiment. I'm in the same boat. I have owed every year that I've been a business owner. And behaviorally, I don't know. It's like it's a funny thing. The Loch Ness monster under the water. I just know it's coming, right? It's under there. Yeah. I can't always see what it is. And even when I do tax estimations, I know it's variable based on, general business outcome.
But do you actually save your cash in a separate account?
I don't. No. I try to keep business liquidity like significantly higher than I need.
Yeah. I'm actually right now going into my QuickBooks to see my revenue this year.
To make sure your tax accounts. I mean, I should have a separate tax account, but I don't. And actually 2020 will be the first year that we are not following the efficiency doctrine. I got married in 2020. So my wife has a job, W-2 withholding. We didn't do all that planning for what exactly those taxes would be. And I think we're getting a slight refund. I'm on extension, but
I think it would be interesting to actually see what different people are doing in terms of different businesses. So like a restaurant, how do they manage liquidity? What do they do? A well-managed restaurant, right? But not a big restaurant. So not like they can open up credit lines and stuff like that. Opening up credit lines is like cheating.
But that's part of the efficiency thing. So
it is. I think it is truly part of the efficiency thing.
Right. But one of the most interesting approaches I've ever heard to this was Dan Egan, I think head of behavioral something at Betterment, wrote up a long piece about how he manages cash, and he's super, super low on cash and uses a lot of credit and invests very, very aggressively from like a total amount invested standpoint. He's got a good detailed write-up and using systems like Betterment that can do dynamic transfers between brokerage and cash.
Yeah, keeping the cash at the minimum level.
Right. Yeah. That's efficient if you can get it, but for most people, I think it's pretty tough. It can be risky. You've got to be a really patient, solid investor. You've got to really understand the risks that you're taking because you could be in a liquidity crunch at the same time investments are down and have this forced selling.
Think about it. March 2020, right before tax time.
Yep.
It would have been a disaster. Like you would have been down 30% for the year.
Yep.
It's not a good thing. I think you need to have excess liquidity if you want to take that route and make that bet. So like if your taxes are 100K, well, if you have investments 150, then you're good, but you're taking that bet. It might cost you.
150 is too low. Yeah, you need to be at 30% taxes to value, something like that. So if you think you're going to write a $100,000 check for taxes, you should have a $300,000 taxable investment account. That's my take.
That's your take. It's a solid take here. Not many people will achieve that.
Didi.
Yeah. So it's quite interesting, right? Didi went public, massive public IPO, and first of all, Didi is a ride-hailing service, ride-sharing. It's essentially Uber, but just mainly ride-sharing. It hasn't been able to diversify the way Uber has. Uber, I think most of their revenues at this point is from food delivery.
Most?
which is, yeah, I think so.
Wow.
At least the first quarter revenues. And so Didi has struggled to diversify. And on top of that, they went public, and then China's Cyberspace Administration Bureau, or whatever you want to call it, ordered the app stores to remove Didi from the marketplace, the app marketplace. And they just launched a review of their security practices. I don't really understand perfectly what the security practices you should review, but like from a perspective of an investor, like there should be an order to this stuff. Like you have this stuff and then you go public. Why go public, before you have this stuff? So I bet you there's going to be lawsuits. The issue is that in the disclosure document that for the IPO, the S1, and the risks involved, that there's a line item there for government scrutiny and other things, regulators. And so the question is, did they know ahead of time that there was going to be a review? Apparently they didn't. Or they knew about the review, they didn't know that they were going to get removed from the app stores. Mm-hmm. And so that's definitely going to have a little bit of an issue for next quarter in terms of revenues. But it's just the murkiness of doing business in China. Like you don't know, you're at the whim of a regulator. There isn't, I would say, a set rules of how to do business. And it just becomes difficult to do that. On top of that, there's one thing that really bothers me with investing in Chinese companies is a lot of them, you're investing into a Cayman variable interest structure. And that structure is not an ownership structure. You're actually investing in the right to some sort of benefit revenue, like the right to have an interest in the company.
It's like a beneficial claim on the company.
Yeah. And so you don't have direct ownership. And so essentially, if you think about stocks being fractional shares of a business, this is not the case for Chinese companies. It's just because the law doesn't allow foreign ownership
direct
of many businesses.
Ownership.
Yeah. Yeah. What are your opinions about this?
Definitely sketchy to be removed from the App Store, like 4 days after IPO. Can't imagine how much the lawyers are scrambling for this. There's a lot in there that it starts to get really murky really quickly. So the Cayman entity is one piece of it, but then the whole notion of a company headquartered and doing business in one country, IPOing in another country is a little bit, I can't quite wrap my head around that. I know that the main purpose is to access capital markets elsewhere, right? Like you want the investors from the US. So you go through the expense and the headache of IPOing on the New York Stock Exchange, right? Yeah. That main part I get, but there's many more political and strategic reasons underneath that I think are tough. And what I read about this situation is that China, the Chinese government in general, is not keen on more companies IPOing in the US, which I'm not sure if that's true or not. But it's a maze out there. So I'm with you that less complexity, less kind of chain links of causation is generally better for understanding and probably for investment outcomes. Yeah.
There's also the issue of the integrity of the accounting system with companies in China. If you want to hear about companies that look for fraud, or investment houses, investment firms that look for fraud, most of them are focused on China. It's hard to find those in the US. You have people who do bad stuff in the US, but it's not as common to see that lately that we've seen in China, right?
Luckin Coffee.
Oh, that was a huge one. I mean, that's such an embarrassment, So, Starbucks of China, they called it. Look where it's now. So wiped out billions of dollars of valuation. The other part is the variable interest entity structure. It allows Chinese firms to get capital in the U.S. And it allows U.S. investors to invest in China. But again, China, the rules say that these firms can only be owned by Chinese, and in the U.S., when you're listing them, they say that you have a beneficial claim to the ownership of that company, and then so one is wrong. I actually think that the latter one is wrong, but I don't know. So a lot of companies are structured this way. JD.com, Alibaba, Tencent. You don't own. You don't have beneficial ownership of these. So it's just Chinese law. They prohibit foreign ownership.
There's other countries that do that too, for sure.
Yeah. So the structure has been around for decades, kind of implicitly saying it's okay, but still, there has been no explicit law or something saying that this is an okay structure. To me, there's a risk that the structure, the variable interest entity structure, might be illegal under Chinese law.
Interesting.
And so if that happens,
foreign shareholders are wiped out.
Yeah, it's a nuclear button. So I don't know. We'll see what happens in the future. You don't really have ownership of the company's assets. So, assets technically can be taken away without compensation to the shareholders. And that kind of thing happened, if you think about it, with Alibaba and Alipay. Because technically Alipay was essentially built inside Alibaba. And then suddenly the Jack Ma and his the top management realized how valuable Alipay would be, so they just bought it out.
Ant Pay?
It's formerly Ant Financial and Alipay.
Okay.
Yeah, there was a lot of controversy of how that got taken away from them. All in all, the risks of investing in emerging markets where the rule of law is not settled in the courts, but in the connections that you have. So I prefer to invest in the US, Nordic countries, the UK. Germany is still okay. France, you're getting in there borderline. Latin America, I'm from there, so I understand it. I understand the issues and stuff. You don't have that level of. You still have the court system, and it works. It just works so slowly, and you still have sometimes events of. I think the corruption in Latin America is like to accelerate processes rather than to change outcomes.
Right, whereas it'd be slower in Europe, slow things down.
Yeah, Japan, you still have like activists. I think Singapore is still a good jurisdiction. New Zealand, Australia. There's a lot of good jurisdictions, and that's kind of where the investment opportunities are. Technology's there and stuff like that. But other than that, it's tough. China is like a huge market, and it's unfortunate that you don't have the safety and the
investor protections.
Yeah. And that's it for the topics of today.
I like it. Good work.